Happy Independence Day, Subra. We are starting early shooting today, and we're going to talk about a very, very interesting subject, which is about what happens when we are early in our investing. Over to you.
Okay, let's start with what is investing. Investing means buying some asset today which you hope will give you good returns post taxation and post inflation. It will give you a real return. This is what your so there are various styles. There is contrarian, there is momentum investing, all those things. And early entry into a sector is always better than a late entrance. But early entry has some challenges. Like for example, infrastructure in India did not, as a sector, did nothing for a very long period of time. So it tests your patience. Second, everybody criticizes you, saying, oh, this guy has got it wrong, he's too old, he should retire. This is a country which was advising Sachin Tendulkar to retire way before. It was asking Prashant Jain to retire way before. Right, so I think it was a premature retirement even for Prashant Jain. But Prashant Jain is one person who had a style of reaching a party early. Right, so yes, it tests your patience, but it pays off hugely because the full PE expansion and DPS, you captured everything in that party. Party starts at 5 o'clock in the evening, goes on till 12. You reach at 3 o'clock. That 3 to 5 tests your patience. Your trustees, your board of directors, your investors, your colleagues, your the press, journalists, and today YouTube channels and blogs. Everybody is willing to write you off. They forget that you have a 25-year track record. Everything is forgotten in that 3 months or 4 months when your performance is not good. So I think as an investor open to public scrutiny, or as a fund manager who is anyway open to public scrutiny, your skill lies in having the patience in your own conviction, which can only come from your own research, meeting the management and the macros, right? You're looking at all of this and you decide. I remember one fund manager saying, should I be buying Coal India at a PE of 6 or should I be buying HDFC Bank at a PE of 36? This is exactly what he said, right? So there are times when you have to take a call saying, I am basically a value investor. I may reach a party early, but reaching early is less of a crime than leaving late. Because that can happen that you wait for a very long period of time, and for a long period of time it's flat. It got the raise, you reach the party late, so you don't want to leave, and then you waste time. So all these things happen, and different styles, because what happens is you have not reached the party but the contra guys have started buying, right? So that can happen, and there can be some jump in the let's say pharma industry during corona. Everybody said, wow, this is great. It did go up, but it didn't go up to its previous highs even then, and then it came down, and now again people are buying. So it's very difficult to be able to time the industry and the company right. The other advantage is when you enter a party early, you have a choice of what to buy. You can buy the leader or you can buy the laggard, because when the party starts and everything goes up, the laggard perhaps goes up higher in terms of percentage, but that's a skill which only a fund manager can do. The common guy is better off, if he's reaching a party early, is better off being with the leader, knowing that during bad times also he won't lose his capital. So if he has to stay for a long period, he does not have that risk. But ultimately, all styles work, and at each point in time, different styles work. Ultimately, if you're going to make money, and let's take you took an FMCG. FMCG did not participate in 2003 to 2007. That was a time when everybody said, wow, what a great bull run. But FMCG and pharma didn't participate, and they started participating from 2008, right? So you reach the party early, you reach the party late, nothing matters. 2003 to 2007, when the whole world was enjoying the Tata Power and BHEL going through the roof, your portfolio of Colgate and HUL was going nowhere. So you got exhausted and said, oh, it's going nowhere. You got out in 2008. You could be completely wrong, because that is when the pharma and the FMCG party started. So it's very difficult to do it. So either stick on to a good quality portfolio and say, I don't care, I don't understand market cycles, so I'll do that. Or you try timing the market with a portion of your portfolio. You could be wrong at times, sometimes you could be early, sometimes you could be late, but being early is not so much of a crime. But yes, it requires patience and the peer pressure, being able to handle the peer pressure when everything else is going up but your portfolio is not going up.
Being early is so much of a value investing thing. Mostly value investors are early to the party. Their orientation to buy something cheap itself makes them early to the party. So that orientation is also their kind of kavachakundala. It keeps them protected, it's their shield of protection, even in the worst of times, because you already bought something extremely cheap. You would have had a good dividend yield, you would have bought it for its value, your price to book would have been low, you would have bought it at a lower PE multiple, and you would have not paid anything for growth. Now, this is a beautiful construct if you look at it independently. But add this spice or garnish of time, then people start saying that, oh, great recipe, but it takes so much time to cook, right? But that's the nature of anything that gets ultimately priced at stratospheric heights. A 50-year whiskey is definitely going to get a great value and far more premium than what a 12-year whiskey gets. I'm giving a very simple analogy. The same thing applies to wine, but the raw material cost for both is the same. There's no difference. So the value investor who gets in early is like the guy who has to decide whether he wants to make his portfolio like 12-year whiskey or 50-year whiskey, or a cheap wine or a super premium wine. That in essence is what early investing or being early needs for success. And being judgmental about being early is not going to allow you to premiumize your idea. Basically, if you're going to allow peers to become judgmental, they're always going to say, why are you keeping this? Why don't you go into this? Look at this, this will go up faster. And that is always going to be there. It's like an example which I always see. When we head into one of these NHA tolls, there will be 4 queues. And you are always wondering which queue to get into so that you will get out faster. The investor mindset is also somewhat like this guy who is driving into the queue of the toll. He wants to go out faster. He doesn't realize that this is something which is most unpredictable and you have no control over it. Yet you believe that you have the techniques to control it. And actually, if you are doing a 500-kilometer journey, how you get in and get out of a toll hardly matters. It's irrelevant actually. But most of us are trying to be clever at the toll booth, trying to get out first and trying to prove that we are smart in the near term. Now, value investors generally come out looking silly at the toll booth. This has been my experience most of the time. And peer pressure is always going to point out that, hey, you came out late. Look what you did at that booth. Whereas the growth investor is going to wait for his time at the toll booth because he knows the time it takes to cross that is irrelevant. And he knows he is making a 50-year whiskey or some great wine. So what is it that it takes for an investor to get this early into his psyche? Because today investor get a different thing into his psyche first. He is thinking that he has to ride his investment like he is riding a super bike. And he thinks that he can even jump from one super bike onto another while he is riding one. So that is the general mood of the investor fraternity. What is it that a young investor or a new investor or somebody who is just coming into investing has to take in to get this basic understanding of what it takes to be early, what it means to be early, and what it can become by being early?
I think first of all, to become a good investor, you should read books because that is going to keep you busy. Second, you should do some activity other than investing. Otherwise, there's a tendency to look at your portfolio every day and compare yourself. Like for example, if you buy a particular share and you find a big investor, mutual fund manager has also bought, then when you think the value is still to be captured, or you bought a share at 100 bucks, it has gone to 200 rupees, you are happy with the price movement, and this is the time when that fund manager starts pairing his position. He reduces, and you think, oh, this has got potential to go to 300. Your skill in sitting tight from 200 to 300 is also being tested, and that journey could be very quick or it could take a long time. 200 to 300 is a 50% jump. Even if it takes 2 years, 2.5 years, it's a fantastic return that you're getting. And remember, because you bought at a low price, you're getting a dividend yield, so you're being paid for sitting patiently. So you're being compensated in terms of dividend and in this potential. So during those times, to look at your research and say, will the PE go up? Will the EPS go up? What else is happening? How are the peers doing? How are the peers doing across the world? Being able to apply your mind to all that and sitting calm, not worrying about what that fund manager is doing, because you don't even know what the fund manager is doing. He's perhaps reducing his position because he's built a position something else. He needs to fund that, he has some other opportunity, or he is reducing risk. He's gone from 100 to 200. He's very happy. He's booking the profit here because he's made loss elsewhere.
Or his investors are asking for his money.
Yeah, he has redemption pressure. You don't have any of those pressures, so you don't have to succumb to what he is doing. So during those periods, also sitting calm, because others are doing something which is, and these are people whom you respect. It is not that you don't respect. So then maybe you pick up the phone and ask him, or if you can't do that, you just say, no, I think my research is right, and I will wait. So having those skills, having conviction in your own research, being able to talk to two people, because I think being able to talk to two people is worth about 2 months of research. Whatever you do, ultimately numbers are numbers. So you will arrive at the EPS, you will arrive at the potential PE, you look at the institutional buying. One foreign institutional guy comes and buys this stock and it could go to 300. Those are things beyond your control. You have no clue that is going to happen, right? So during those times, to read books, not magazines, not even blogs, not Twitter, to read and have build your conviction, right? That's very important, and that can be done. It's not so difficult.
Talking about buying when others are selling, we just mentioned that sometimes redemption can make people sell even stocks where they have conviction. That's a typical problem of a investment manager, of a professional. So when that happens, he is going to sell for reasons other than investment merit. If you are buying from him, you would have bought a few thousand shares. He would have a few million shares to sell. You would have bought these few thousand shares on the first day he is selling, and he is going to sell for 20 days. So these 20 days, he would go on selling. Every day he will place orders because he has to close his position and get the cash out of that position. So you would be so early, and you will find the share going down 15-20% after you have bought it. As you buy itself, just because of the investment compulsion of somebody else, you could be on the wrong seat, or you could be on the wrong time of the bus. How do you manage sitting on that bus? And what do you do when you see that minus 20%, minus 25%?
No, I think last 10-15 years, we have had to understand this risk because FIIs do this. FIIs have lost money in Brazil, so they're selling in India, or they've lost money in China, so they're selling in India, or they made so much money there, they're selling that, and therefore they're investing in India. You don't even know why they are investing. Are they investing for liquidity? Are they looking at Indian market? What are they doing in F&O? You need to know all this to be able to react. So when a foreign investor sells, you look at what is compelling him to sell. That could be completely non-investment reasons, like you said. Then you also look at why the domestic guy is selling, and he could be he may have reached 9.8% in his holding, so he may be forced to reduce because of legal reasons. That is again a non-investment reason. He could have redemption. So you have to look at all that and then take your decision. It's not going to be easy. So you will, if you built a very big position, you may also pair pare down saying, okay, 100 to 200 is not bad, let me reduce it a bit. I have full conviction, but still, why take risk on all my 1 million shares or 2 million shares? So I'll reduce half of it, and then I will hold on from 200 to 300. You do it 2-3 times, then you build your own conviction. See, conviction is like a muscle. You keep exercising it and keep using it, it gets stronger. So once your conviction is stronger in your own skills and your team skills, you get better. So I'm sure a Prashant Jain when he was 23 or a Naren when he was 23, 24, he would not have had so much conviction in his own research. Obviously, he would have had some conviction, but this conviction would have got built over a period of time, and now people are saying if Naren is not selling, it means it's a good thing, or Prashant is not selling, then it's a good thing. So they have exercised their conviction so much that with 20-25 years experience, their conviction is stronger than what some younger investors will have. So younger investors should look at them, either look at foreign examples or you look at Indian examples and see what they have done and try copying their styles. Don't copy the same shares, but copy their styles. Learn how they sat for long periods of time over things which are very obvious that it should go up, like like buying a telecom stock when it is down. It is part of infrastructure. Every country needs it. Every guy on the road you see him using YouTube, watching videos. So you knew there is a data market. You know there is a data market. You know it will grow. Then the conviction to buy the share at 200 rupees and holding on till it reaches 1500 or 1800, that's your skill. So enjoy the journey, keep reading, talking to people, and that's the only way to do. What else can you do?
I'm going to pick on a quote that you just made in passing, which came like a flash actually. Being early, you have a lot of time. So you need to spend that time correctly. So you mentioned about reading. Now to the quote. You said, conviction is like a muscle. I'm going to add a line, which means that when you're early, the best thing you do is you understand that conviction is like a muscle and you keep toning it up and keep building the tone of your conviction, because conviction has multiple tones. There's early conviction, there's mid-stage conviction, then there is growth driven conviction, then there is a mature conviction, and then there is a conviction which needed to sell also. So basically your conviction has several tones. So when you are having a lot of time, I think focusing on the tone of this conviction is something that one can profitably do, gainfully do. Though it doesn't change the value of your portfolio, it's changing some intrinsic quality within you, which will eventually show in your portfolio. I think that if you look at how you handle similar ideas across different cycles, the only thing that changed is the tone of your conviction, because your maturity to tone of your conviction. And when you tone your conviction, it becomes very, very strong and sturdy, robust, and you are able to do much more agile things with that conviction than you did in your first market cycle. But I find that people are trying to tone that conviction too fast. In one cycle itself, you want to believe that you are a super investor, which may happen, but it's probably unlikely, because the time taken to tone conviction is even longer than the time taken for ideas to become mature and give you the fruits. It's like a tree growing from a sapling. So conviction also is like something which needs time, needs nourishment, needs toning up, and needs shaping up also, because you cannot just allow it to grow wildly. There's a lot of things that you need to do to bring it to a certain structure. And people who allow it to grow wildly, thinking that they have the ability to manage it whenever they want and in whatever form they want, in whichever direction they want, are going to always get caught in one moment with the wrong conviction. So this toning up of conviction is basically what makes it good muscle, which gives it that MRF logo type of robustness, and which also gives it MRF type of returns eventually. So I feel that early investors have to be a little more humble in their conviction, because I find that when you're early, you should not talk too much about the idea with too much conviction. Just allow it. You keep it in your mind, talk to a very few people, test it out, see what people are telling you, and take it as it comes. That is one thing where managing the self is the more critical ingredient in early investing. If you can't manage yourself, you are going to sell.
No, generally in investing itself, managing yourself, like for example, if you hear that real estate is booming and you are not convinced that you got good real estate companies, you could go and buy a Kajaria ceramics saying, oh, this is better, because ultimately people buy houses, they will put tiles and those things will happen. So you can ride the peripheral companies also. It's not that only one company. If banking is doing well, the banking related companies, the mutual funds, insurance companies, the stock exchanges, all of them would also be participating. So you did not get the main bus, you can get the side buses. So again, like I said, you have to believe that whole industry, the BFSI is going to do well. I think the banks are expensive, so let me buy some of this share. That can also work. So having parallel strategies, seeing what is working, seeing who is buying, who is selling, right? Whatever you can get in the public domain, all that builds your conviction, saying, this guy is also buying, this guy is buying. And in your own portfolio, Shyam, it's also important when you are young and you are just starting, you are not worried about portfolio sizing and portfolio weight. So you may be 90% in one idea of yours which has done well, but as the portfolio size increases, you want to reduce risk also. So for non-investment reason also, you could be selling something saying, I have 18% of my portfolio in this is too high, I don't have any rules, but I don't want to be above 15. So you may yourself sell even in a share on which you have a lot of conviction, in the industry in which you have conviction, you will say, let me pare down my position. So all these things will happen.
We spoke a lot about conviction, which is so critical when you're early. We spoke about the merits of being early, because there are clear merits in being early, because you're going to pay the same price in your cost, whether you want your wine after 6 years or you want it after it's really aged to great value. So being early is a virtue, but having the conviction is a necessity. Now I'm coming to the third point, which is, how do rules help someone who is early? Do you need rules at all if you're early?
See, rules help you and rules hurt you. So I'll give you an example how it helped me. I bought Apollo tires below par because it was a great dividend yield. In those days, I would buy shares and compare it to Hawkins. It used to be called pressure cooker appliances, fixed deposit rate. And if it was somewhere near, I would buy it saying, anyway, the share is going to appreciate. So I bought Apollo below par. And I was getting a good 10%, 11% kind of a dividend yield, where in a country where fixed deposit interest rates used to be 12%, 13%. So I said, here I'm going to definitely get dividend yield and it is going to appreciate. So definitely my returns will be higher. And those days, you may not remember, dividends were tax-free up to 7,000 rupees. So I said, wow, it was fitting into that. So I bought Apollo Hospital. And I held on. Then my rule said when it reached 135, remember it was now a 13 bagger. I bought it at almost 10 bucks, so it was a 15 bagger, not 9 bucks or not. So I said, this is fantastic. I mean, I bought it for dividends, or dividend yield I was getting, and this appreciation came as a bonus. I didn't know it's going to appreciate so much. So at 135, I thought it was a great sell and I sold it. But what happens is the market perception of Apollo from a bad corporate governance where the private sector, private companies where some money was perhaps being diverted, it's very difficult to know as a small investor. So after that, the market started changing the perception and it moved there straight into the Nifty, right? Over a long period of time, yes, where 10 rupee share has become 4,000, 5,000. Market perception, people bought, COVID, all that put together took the price there. I participated in it intermittently, but once having seen at 10 bucks, it's very difficult to enter and re-enter, especially if you have rules. Even though you're an individual investor and you're not bound by those rules so strictly, if you don't do it, the losses could be much higher. So you make your rules, you gain, and make your rules, and sometimes you get hurt.
How do you make rules that make you win?
That is that is the difficulty, because one thing, as an individual investor, you don't need to wear a hat. You could buy something in the morning, and by the evening, if something happens and price goes up, you could sell. So you're a day trader. Sometimes you're a position only trader. So I do that. I buy, I take a position and I sell off. If I'm not very happy with the corporate governance or what I think, I still buy it and sell off. Some I hold for 3 years, some I hold for 10 years, some I've been holding for 40 years. So all those rules happen. So one thing is very clear, that when you buy a share and you don't sell it for 4 years, it is not a decision to hold it for 4 years. It is 16 decisions of not wanting to sell on a quarter to quarter basis. So every year you're taking, then you reach a stage and say, this is permanently there in my portfolio. A quarter on Colgate or HUL or any Pfizer doesn't really change much, right? These are things which are going to hold. COVID comes, Pfizer will be more profitable, or things like that. You just put it on the side and you hold it. So you create a portfolio without wearing any particular hat. You say, okay, some portion I'm a day trader, some where I'm a position trader, somewhere I'm a long-term investor, somewhere I'm a deep value investor. I'll take a 8-10 year view. You create a portfolio with all this, and overall, if you're happy with the returns, and Shyam, I think most importantly, if you think you can meet your goals, then you don't get too much into the rules and things like that, because it's very difficult for you as an individual investor to make those rules, stick to those rules. You're not creating a big trustee, board of directors and all that. So it's very difficult. So you do this and you then hope that you create alpha, and not that hope is a strategy, but you see that it is working for you. You can't be very rule driven. At least 50-60% of your portfolio you may not be rule driven, but certain portions, especially when you're taking a big position, you better make rules, discuss it, and then only go ahead and execute it.
So rules in your view are not absolute, but they are necessary, and where they are essential, you can't overlook them. You should not ignore them.
You should know why you are breaking a rule.
So that's a very interesting way to look at rules, because rules generally is boxed into black or white. You're actually putting rules in the domain of gray and saying that you decide where you need them and move them whether towards black or white, or just leave them in the gray zone and don't bother. So it's making it very, very easy on the person to choose and very difficult to decide. So in that sense, rules actually are never easy.
Look at it this way, if I had an X amount of money which I were giving to 4 managers to manage, I would make very strict rules. I am the owner, I will decide which rule I can break, but he does not. He is a day trader, he has to only do day trade. He is a deep value investor, so I will meet them also on different days. I don't want this hangover to hit this, so I will do that, but this discretion of gray is mine, not my employees.
So the real crisis or the real challenge is for the individual investor, the guy who does his own trading. He is his own fund manager, he is his own position trader, he is his own option seller, he is his own crypto buyer, he is his own global investor. The guy who wants to do everything on his own is really an individual who is doing hunting in a jungle.
True.
On his own.
True.
Without knowing what's the next beast that is going to come before him.
True.
So in that sense, he should respect that, and accordingly he should go in for the hunt, and he must know that when he is early, he needs a different set of tools for the hunt.
True.
And it's a completely different hunt.
True.
And in that hunt, waiting is everything.
Absolutely.
Thank you very much, Subra, for this wonderful discussion.
Thank you.